Everyone tells you to earn more money. Almost nobody teaches you how wealth is actually created. Those are two completely different games. Income pays your bills today. Ownership pays your bills forever. Most people spend decades becoming highly paid employees. Millionaires spend decades becoming owners. That single decision changes everything about your financial future. A high salary does not make you wealthy. It simply gives you more money to allocate. The question that separates future millionaires from lifelong workers is not how much do you earn. It's how much of your income buys assets that will pay you back. Every paycheck has two possible destinations: consumption or ownership. One disappears forever. The other compounds for decades. The wealthy don't measure success by income. They measure it by cash flow. Cash flow is money produced by assets you already own. Dividends, rental income, business profits, royalties, and interest continue working long after your workday ends. Financial freedom begins the moment your monthly cash flow exceeds your monthly expenses. From that point forward, work becomes a choice, not a necessity. Saving money protects your future. Buying assets builds it. Cash loses purchasing power to inflation every year, but productive assets like index funds, dividend stocks, profitable businesses, and quality real estate have historically grown wealth over the long term. Millionaires don't let money sit idle. They put every available dollar to work. Every dollar should have a job. Wealthy investors ask one question before spending: will this asset produce future cash flow or increase in value? If the answer is no, it usually isn't an investment, it's consumption. The average investor focuses on how much they invest. Wealthy investors focus on the rate of return. A portfolio earning 12% annually can become several times larger than one earning 6% over the same period, because compounding accelerates exponentially. Time multiplies returns, and higher quality investments multiply time. The world's greatest investors don't chase quick profits. They maximize return on invested capital, ROIC. Warren Buffett looks for businesses that consistently generate high returns on every dollar invested. The higher the return, the faster capital compounds. Millionaires don't just save money, they allocate capital where it produces the highest long-term returns. The greatest investors don't ask, how much money do I have? They ask, where is my money invested? Asset allocation, the way you divide your capital between stocks, ETFs, real estate, businesses, bonds, and cash, has a greater impact on long-term wealth than trying to pick the next winning investment. Diversification doesn't maximize returns, it maximizes survival. The world's best investors know that protecting capital is the first rule of investing. A portfolio that survives every market cycle will always outperform one destroyed by a single bad decision. Most people think risk means price volatility. Professional investors know the real risk is permanent loss of capital. Before buying any investment, ask 3 questions. How does it make money? What could permanently destroy it? Is there a margin of safety? Wealth is built by avoiding catastrophic mistakes. The best investors demand a margin of safety. They buy quality assets below their estimated value, diversify across productive investments, and never risk money they cannot afford to lose. Protecting capital allows compounding to continue for decades, and uninterrupted compounding is one of the greatest advantages in finance. The biggest mistake investors make is spending investment profits. Millionaires reinvest dividends, capital gains, rental income, and business profits back into new assets. Every dollar withdrawn slows compounding. Every dollar reinvested buys another future paycheck. The wealthy measure success using net worth, cash flow, and return on capital, not salary. Your salary pays today's bills. Your assets pay for tomorrow's freedom. The goal is simple: own enough productive assets so your investment income exceeds your living expenses. At that moment, you've stopped working for money, and your money starts working for you. The highest paid skill in finance is capital allocation. Every dollar should be directed toward the asset with the highest risk-adjusted return. Great investors don't ask, "Can this make money?" They ask, "Is there a better place for this capital?" Capital flows to its most productive use. A dramatic visualization of $100,000 flowing into 4 investments with different returns. One investment earns 4%, another 8%, another 15%, and the final one loses money. The highest return asset dominates the screen with a massive green wealth curve, illustrating efficient capital allocation. Every stock represents a real business, and every business leaves clues in 3 financial statements: the income statement, the balance sheet, and the cash flow statement. Professional investors don't buy stock charts, they buy businesses. If you can't read the numbers, you're investing blindly. Smartest investors follow one simple sequence. Revenue grows, profits grow, free cash flow grows, intrinsic value grows, shareholder wealth grows. That's why legends like Warren Buffett, Peter Lynch, and Charlie Munger focused on business fundamentals instead of daily stock prices. Price is what you pay, value is what you own. Professional investors never ask, "Will this stock go up?" They ask, "What is this business actually worth?" The difference between intrinsic value and market price creates opportunity. When price trades below intrinsic value, you're buying future cash flows at a discount, not just buying a ticker symbol. The greatest fortunes were built by owning businesses with predictable earnings, durable competitive advantages, strong balance sheets, and consistent free cash flow. The market rewards fundamentals over speculation. Investors who understand business economics outperform those who chase headlines. The wealthiest investors in history, including Warren Buffett, Charlie Munger, Ray Dalio, and John Bogle, didn't become rich by predicting the next hot stock. They built systems based on consistent investing, disciplined risk management, diversification, reinvesting cash flow, and decades of compounding. In finance, the biggest returns belong to those who stay invested the longest, not those who trade the most. Your income creates wealth only once. Invested capital creates wealth forever. Master valuation, understand financial statements, buy productive assets, protect your capital, and let time multiply every dollar you invest. That's how ordinary people build extraordinary wealth. Welcome to Broke to Build, where we don't chase money, we build financial systems that create it.